Hey everybody, and welcome to this guide to options for beginners. I'm going to be covering strategies, Greeks, and basics for into 2020 and beyond. Whether you're watching this a year from now, a week from now, a month from now, 5 years from now, this is evergreen content. It's still going to be relevant years from now because these universal things don't really change. Make sure to comment below your own input on different options trading techniques and tools that you use and all that kind of stuff. I'm going to be covering a lot of that in just one video. Totally free course, total free tutorial. It costs you absolutely nothing to watch. Just leave a comment below, leave a like if you like the video, so on and so forth. But we're going to hop right into it here. Basically, options are pretty straightforward. You buy a contract. Buying a contract is like buying the equivalent of wanting to potentially buy up to 100 shares of a given stock. You have the right, but not the obligation. So you can sell and close that out at any point. A lot of people capture on the premium value, which is kind of the value mixed in with a lot of different variables, which I'll be covering in this video. So make sure to watch the whole video so you don't get confused. But the short answer is that each option is the equivalent of 100 shares that are valued at a certain price based on the Greeks, based on different in the money, out of the money, at the money valuations, intrinsics and extrinsics. I'm going to cover all of that here, so we're going to hop right into the next aspect here after I bring up one more thing about options here. And options are basically kind of high risk comparative to just normal shares because you're basically amplifying your risk by 100 times, but you're only paying based on a premium. You're not quite exercising the shares at the time, so the costs are kind of less, but kind of more. And I'll be getting into that why when I get into the Greeks here. Greek's pretty simple. Some people overcomplicate it, but essentially it helps to measure the risk that you're actually taking when you enter in an option position. If you really don't know the Greeks and you're kind of going in blind, you're taking a lot of risk, a lot of capital risk, especially with some strategies that can result in infinite risk, margin calls, things like that. Margin calls, very, very bad for you. It's basically like taking out a loan, but then you're taking out a loan with that amplified risk, and you can get your position sold on you, and you can end up owing debt and have to pay up on that debt essentially because of a strategy that you did through options that you didn't quite understand. That's why I'm going to cover the different Greeks in this video. And we're going to start off with a delta. Delta is one of the most simple Greeks to understand, that when a stock moves a dollar up, a dollar down, that rough move on the delta is what the premium will move. So if you have a delta of 50 cents, you'll have basically a $50 move because it's an amplified 100 shares. So that 50 cents is basically the equivalent of $50. So every dollar that stock moves for that share price, that is that $50 for the each time that it does. But then there's other Greeks that mix around and involve and change that rate. But we're gonna get into the next one here. Probably questioning why there's a kind of decaying barn, all that kind of stuff. It's where theta comes in. Theta is basically a decay or time sensitivity based on the longer amount of time that you hold it. As the expiration decreases, that gets much and much more rapid. Uh, each day you lose value on your premium. So if you hold a stock that has a $20 loss premium for that day, the next day you're going to lose $20 no matter what the stock does. Now, if it goes up from that, it offsets with that up. If it goes down from that, you're taking even more of a risk because you're getting the theta decay, plus you're getting some other things too. That's where extrinsic and intrinsic value come in. And I'm going to be getting into that here in just a second, but I'm going to wrap up some of the other Greeks here. Wondering probably why there's a camera. Gamma. It's basically the rate of change between an options delta and the underlying asset's price. Essentially, kind of an exposure here. So if you have a delta of 50 as they use and a gamma of 10, so if the stock goes decreases by $1, the delta's option would increase or decrease by 10 cents. So it's kind of an amplified gamma risk. Obviously, gamma can change at any point. Delta kind of goes up and down on some other variables, which I'll be getting into in a second here. But obviously, if you're looking for an upward movement and bigger movement, you want a higher gamma and you'd want a higher delta as well. But obviously, that in turn creates more risk because on the downside, that's going to be a magnified risk on the downside too. And probably wondering why there's change. Vega represents the rate of change between options value and underlying assets implied volatility. I haven't quite got to implied volatility, but volatility is volatility. It's like a measurement of the extrinsic value or the kind of like a hype value. Like if you're expecting an earnings report coming up, and you're expecting it to be positive, there might be a lot of extra implied volatility up to that event, so that volatility gets higher and higher and higher, and that in turn makes the option itself more volatile. Vega indicates the amount an option's price changes given a 1% change in implied volatility. So, for example, if an option with a Vega of 0.10 indicates the option's value is expected to change by 10 cents if the implied volatility changes by 1%. So, obviously, Greek math here, Vega helps to give an idea of what the volatility might be moving towards in the days, the weeks, to months to come. If you're day trading, it could be important to watch, but I think it's more of a swing trader indicator than anything else. Represents growth here. Rho, not super relevant to most people. Day traders, not really. Swing traders, not really. More like swing to long traders that you might want to watch this, but it's basically a measurement on the interest rate. The measure sensitivity to the interest rate. For example, same call option has a row of 5 and a price of 1.25. If interest rates by 1%, the value of the call option would increase to 130. So kind of relevant with some of the stuff going on with the Fed talking and all that stuff. But they already said they're not really talking until basically after election, so not really relevant to this point. If you're watching this currently, but if you're watching this in the future, depending on when the Fed talks next, depending on what they do for rate changes in the years to come, it kind of would affect this. But on a short term, you won't really pay attention to this. It's not really all that relevant. There's some other minor Greeks as well. Lambda, Epsilon, Foma, Vera, Speed, Zoma, Color, Ultima. I really don't use any of those. I really feel they have very little impact on the overall. Depending on if you're doing more complex strategies, but as a beginner, you're likely not going to be using any of those minor Greeks. Here's a big owl for you. Volatility. It's covering implied volatility earlier. You want a lower volatility going into a higher volatility. Too much implied volatility means that your option premium will likely crush much more rapidly. Essentially, you're buying in, like I said, an extrinsic and hype value that has no value at all. And I'll get into where the value comes from here in just a second, where what's considered intrinsic and what's considered extrinsic. But the short answer is that you want to buy a lower IV into a higher IV. My personal preference is, anywhere from 40 to 80 range IV for most stocks. Anything above that, you run a very high risk of your option being IV crushed or just crushed in general, which means that if you bought that extrinsic value and your option gets crushed, your premium does too. So you can lose a big chunk of percentage of that monies almost instantly if that option gets crushed. You never want to go over 100 IV. If your option's hitting 100 IV and you're still in it, you might want to sell as quick as possible, unless you're just scalping very quickly in and out. Then there's a room for margin, but then the bid-ask spreads get a little bit goofy in that regard. At the money and in the money and out of the money, I'm going to be covering here. You can buy different strikes. Different strike prices are basically your entry point. If you buy an at the money strike, you're buying it literally what the exact share price is. So if the share the stock is trading at $50 a share and you buy a $50 strike, you're buying it at the money strike. It has no intrinsic value. Intrinsic value is basically the amount that it moves in the money. That's pretty much all there is to it. Gonna hop into that here right now in the money. So if you buy a $50 strike price, strike is basically where you're buying it at, and expiration date is the specific date of which you might want to consider exercising. That basically the in the money value. So if you have a $50 strike and it hits $51, you have a $1 in the money value, a $100 intrinsic value on that option. No matter what else it does, you have that intrinsic value. But then a lot of people buy that extrinsic value with the implied volatility, as earlier mentioned. Implied volatility is basically a hype valuation. So you have the hype valuation, which can go up and down quite rapidly, but the intrinsic value is always the intrinsic value. So if it holds that intrinsic value above that amount, you'll always have at least that core intrinsic value there with you. But of course, if you have a crushed option and then your intrinsic value goes back out of the money. Out of the money is basically a zero value, a negative value. The only thing valuable in it is basically the extrinsic value hype aspect. In other words, the implied volatility. That can crush your option to basically nothing. You can lose 100% of that because it has no intrinsic value. It has no in the money value on that option. I don't know if this is clear to you guys or not. Can be a little bit complicated. You might want to re-listen in a few times and, maybe cross-reference some other examples and things like that. But you got in the money, which is intrinsic value. You have out of the money, which has no intrinsic value. But in the money, out of the money, and at the money can all have extrinsic value, which is based on the implied volatility and based on the previous Greeks that I mentioned, like gamma and rho and all those kind of things. They all kind of come together to create that ultimate ending option strike price. But we're going to go hop into the next aspect here. Kind of puts all this into perspective, but then we go into the expected move. Now, the expected move kind of depends on the value that the particular broker puts into it. For Tastyworks, the expected move is the amount that a stock is predicted to increase or decrease from its current price. So it creates kind of a range. So anytime that your option goes out of that expected move, your IV can go up, and that in turn can mean that you can make a lot of monies on that particular option that you got in. If you have an out of the money option that went deep in the money, the out of the money option had no intrinsic value, but as it rapidly moved into the in the money amount, the intrinsic value coupled with the extrinsic value can create a big surge on your premium value. And of course, you can sell your option at any point. You don't need to wait till the specific exercise date that you bought. You can close it out literally this next minute if you wanted. You don't need to hold on to it. Expected move. This is just a representation of how Tastyworks shows it, but if it's in that range, your option's relatively safe, but shorter term expirations shrink that amount. So that orange little ruler that gets smaller and smaller and smaller, the less likely that move is to happen. So when your option falls out of that expected move, your option gets crushed that much more rapidly. Back to the high implied volatility. If you have a high implied volatility, your option is going to get crushed just that much more magnified. Very, very dangerous if you don't understand that. So make sure to rewatch over that part there to get a full grasp on that. But we're going to cover, what kind of accounts you should be using for options and what kind you shouldn't be as a beginner. You got two ones here. You have a cash account. Cash account means you're using your own monies. You're not risking anything on a margin level play, so you can only lose as much as your own cash. Margin accounts is where people will get into trouble because then they start taking out basically margin loans. So you're taking out a loan that does have interest on it, so that if you make a mistake, you not only have to pay that margin loan interest, but you can get potentially margin called, and margin called means that they'll force sell your position, And if you still can't afford it based on your position sold, they start asking you to deposit more money from your bank to cover said position. Some plays and options can result in infinite risk. These are not plays I'd recommend for beginners, especially if you really don't know what you're doing. I'm going to cover a little bit here into different brokers I'd recommend, but essentially, TD Ameritrade is one of the better ones out there. You got Tastyworks, a lot of different filters that you can look through here, but essentially presets here, a lot of different choices, a lot of different things. It seems a little complicated at first, but there it has the IV listed as I mentioned. That changes a lot of different things, volume and different events coming up, and you could search different types of filters, a lot of different things to choose from there. Webull is kind of more like a swing shares trading, but you can still use it for options too if you want to save a little bit of money. Webull is free. Tastyworks costs $1. Tastyworks, I feel, is a little bit better of a platform, but if you're on more of a budget, Webull would be the one to go to. Trade UI is basically a visualization of option sweeps and options flow and gives you an idea of where big money is putting their monies at. I have tutorials on that if you want to check them out. I'll link them in the description below. But there's a lot of different filters that you can utilize, different expirations, different strikes. You got the ITM, ATM, OTM, and the money at the money, out of the money. You got the bias, calls, and puts, and different valuations and things like that, applying to different strategies. A lot of different variations. Link in the description below. You can check it out and see for yourself. These are just basically risks here. I sort of already mentioned them, but I'm going to kind of re-amplify the point of me mentioning them. You got magnification risk. Options are the equivalent of buying 100 shares risk underlying. So that underlying move up or down can amplify that risk up or down a lot more than you would have with normal shares, which can be a good thing and could be a bad thing, but that also means that your risk is much more rapid. With options, you might be risking more than you realize. You might put in 100, say, hey, this is only 100, but then in minutes you can lose that 100 and that's gone. Uh, Options, if you really don't know what you're doing, run a significantly larger risk. So something to keep in mind. You can get confused with options. You might think you know what you're doing with a given strategy. You might think you know the risk and reward you're actually taking. But if you don't fully understand the option strategy that you particularly are utilizing, you can lose a lot more monies. That's why I recommend to stick to a cash account for beginners and avoid margin completely. Maybe paper trade with margin. Paper trading, if you guys are not familiar, you're trading with a virtual account, costs you $0. So you can try different strategies, see how it works for you, see if you're fully understanding how each thing works. And once you put all that together, then you can jump in with a real cash and do some real trading. Of course, make sure to not trade with emotion as well. Trading with emotion can cause a lot of problems. Emotion is a very, very fickle thing. Some people are a little bit more stable. Some people are trading with monies they really shouldn't be. That can ultimately cause some major risk to you as a trader and you to your financials, things like that. But we're going to jump into the next thing here. Different spreads, there's strangles, there's straddles, a lot of different strategies. I'm just going to cover some of the quick basics here. I'm not going to go into too many details other than, just straightforward. You can buy calls, long calls. Options are leveraged instruments. I already covered that. They amplify the risk. Sort of, you take smaller amounts of risk, but at the same time, that risk is amplified, so you could lose it much, much quicker. Something to consider. It's pretty straightforward. You buy the calls for the expected rise. Risk reward, the trader's potential loss from a long call is limited to the premium paid, so you can only lose as much as the initial premium that you paid. Potential profit is unlimited. Basically, suggested buying calls, buying puts. Pretty straightforward. Same thing with the long puts here. You're basically buying it expecting the price to go down. You can only lose as much as your basically premium that you put in. You have the covered call, expect no change or a slight increase. So if you're expecting the option to stay relatively the same, maybe on tighter float stocks, float, kind of hard to explain in a real quick manner, but the tighter the float, basically, the tighter the shares being traded, which in turn creates more restriction. The lower the float, the more volatility that can be created in order to move that option up and down, or that stock in particular, the underlying, which means that, the tighter the float, usually the better. The lower the float, usually not something you'd want to do covered calls on. But, it really depends on which particular stock you're looking at trading. Some stocks move in a very, very tight range on a week-to-week, month-to-month basis, and there's value in doing covered calls on those particular stocks. A risk reward: if the share price rises above the strike price before expiration, the short call option can be exercised and the trader will have to deliver shares of the underlying at the option strike price. Obviously, that's the risk that you're taking, is that you might have to exercise a massive amount of shares just to cover that. If you have a lot of monies to go around with, there really isn't that much risk involved, because then it's like you're buying the shares and you can always get rid of them later. So really relative to you. Protective put: on the underlying asset and one downside protection. Protective put is a long put like the strategy we discussed above. Blah, 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 blah. The name implies downside protection against versus attempting to profit from a downside move. The price of the underlying increasing is above the put's strike price at maturity. The option exercise is worthless and the trader loses the premium, but still has the benefit of the increased underlying price. On the other hand, if the underlying price decreases, the trader's portfolio position loses value, but this loss is largely covered by the gain from the put option position. Risk, obviously, a lot of options is involved with hedging and things like that, so that is the risk that you're taking in that regard. But we're not going to get too much into detail there. This is supposed to be more of a basics here. Other strategies, I'm going to just read off really quick here. You got the covered call strategy or buy right strategy. Stocks are bought and the advisor sells call options on the same strike. The number of shares you bought should be identical to the number of calls, options, contracts you sold. So you're kind of making maybe a little bit of a price difference there depending on how those options move. Married put strategy: after buying a stock, the investor buys put options for the equivalent number of shares. The married put works like an insurance policy against short-term losses. Call options with a specific strike price at the same time. You'll sell the same number of call options at a higher strike price. Protective caller strategy: investor buys an out-of-the-money option at the time writing an out-of-the-money call option for the same stock. Long straddle strategy: investor buys a call option and a put option on at the same time. Both options have the same strike price and expiration date. Long strangle strategy: investor buys an out-of-the-money and a put option at the same time. They have the same expiration, but they have different strike prices. I'll be covering a little bit more into the straddle and the strangle here. Other ones not really recommended for beginners, so I'm not going to go too much into details about that, other than basically what I read off. Options are hedging, hedging's a risk, especially if you don't know what you're doing fully. Strangle is popular option strategy. Just mentioned that just a second ago. Strangle is profitable only if the underlying asset does swing sharply. So if you have a big swing in either direction, you can profit off of that. Straddle is an option strategy involving the purchase of both a put and a call. Same expiration on the same underlying. Is profitable only when the stock either rises or falls from the strike price by more than the total premium paid. So strangle and straddle kind of similar. Straddle's probably maybe a little bit safer, but you'll probably make less, whereas a strangle, if you're expecting a big sharp move, you'll make potentially more. That's about all there is to it. You can read more about it on Investopedia. I have all the resources below, but I'm just doing some real basics for options here to get you guys kind of understanding of the risks and reward and all that kind of stuff. A lot of different tools. Covered Trade UI already. Trade UI, you can do a lot of different strategies. My personal favorites, I like to basically choose these stocks on a shorter term and make sure they're out of the money with the expiration on the same week. That gives you an idea of just, just how aggressive they want that position. They're spending hundreds of thousands or millions of dollars on a position. That's just a lot of conviction on the short term, especially if you factor in the theta decay that I had mentioned earlier. So that is something to consider. We're going to hop into it here. I'm not going to get too much more involved than that. You can check out Trade UI in the description below if you want more information on that. Tastyworks I already covered a little bit earlier. Tastyworks, pretty straightforward. Options trading platform, options research platform. A lot of utilization of that. If you're going to be using options, I highly recommend getting this broker. They're running a promo right now. Might not be available depending on when you're watching this video, but they run promos on a year-to-year basis, so there's always something going on. Right now, if you deposited $2,000, you basically get 100 shares or 10 options. Obviously, the 100 shares is a little bit better of an idea than the 10 options. They pay between $200 to $250, but you got to keep that $2,000 in for a certain duration of time. More information at the link in the description below if you want to check that out. Another resource I'd recommend is Tasty Trade. Tasty Trade gives you different videos about different things, lots of different resources for options trading. If you're going to use Tastyworks, I'd recommend this particular website. Not much else to say about it. Investopedia I use for a lot of different resource videos to give you guys an idea of how options work, how Greeks work, how in the money, at the money, out of the money, and all that kind of stuff works. Finviz, I haven't really mentioned in the video yet, but you can do back testing, you can do screeners, you can do a lot of different things to find specific stocks that you might want to follow and you might want to trade through technicals or fundamentals and stuff. You want more information on more of the basics of stock market trading, I'll have a link in the description below as well. I'm not going to get too much into detail about that. This video is focusing more on the options trading aspect. Bar chart has something called the cheat sheet, basically, and this can show you different levels of resistance and support if you don't actively use a broker like Think or Swim for charting. Pretty quick references with, you have Fibonacci retracements and a lot of other different indicators. To learn more about different technical indicators, you can check out my other video. I covered that more into detail about that. But, technical indicators cover charting. But if you're watching options trading videos, I'm sure you understand a little bit about technicals and fundamentals and how those all come together. But that about wraps up this video. If you guys have any other input on something you'd want me to cover, make sure to comment it in the description below, and I will cover and answer any questions that you might have. I'll be doing more extensive videos on more specific things mentioned in this video, but this was just, an options traders, beginners video tutorial course, whatever you want to call it, for free. I just wanted to get it out there, give you guys an idea of a lot of different things with options. Options are not as complicated as people make them seem. Ultimately, your guide to options for beginners is right here. I try to keep it as basic as possible for pretty much anybody to understand that's new to trading, or even if you're just a freelancer sort of new to trading, that anyone can get a basic idea of getting started. Just a quick overview with everything. There's been, in the money, out of the money, at the money, extrinsic value, intrinsic value, delta, theta, gamma, rho, all of these things all come together, and that's a lot of different working pieces all together. So you might want to make sure to rewatch this video a couple times, maybe find a little different timestamps I'll have in the description below to find specifics about if it's options you want to go over more from the Greeks aspect, or if you want to rehear the in the money, at the money, out of the money, if you want to learn more about the intrinsic, extrinsic value, all that kind of stuff, I'll mention in the video. I'll have timestamps for each specific spot. But thank you for listening in, and you all have a great day.